Let's talk about the options straddle and why it's such a great delta neutral strategy. The great thing about an options straddle is that it's non-directional. This means that you can make money with this strategy without forecasting market direction. In other words, it doesn't matter whether the stock price goes up or down in the near future, you can still make money either way, as long as it moves somewhere. The idea behind a straddle is that you simultaneously purchase the same number of call and put options, all with the same expiration date. The plan is that thanks to option implied volatility and an option Greek called the delta, the profit from the winning option will more than compensate for the loss on the losing one, with a good overall profit being realised. The options straddle trade is a slow-moving trade that can take anywhere from a few days up to a month to do its thing. It works best on stocks that are in a period of price consolidation, with the expectation that a breakout, followed by significant price action, may be coming soon. If you are a technical trader, one of the best chart patterns I have found for straddle trade setups are what are commonly known as triangle and wedge formations. This is where the recent highs and lows of the daily bar charts are coming together. In other words, the highs are getting lower while the lows are getting higher, so that if you draw a trend line over the highs and lows, you'll see them converging into a point. You'll see an example of an ascending triangle pattern soon in this video. You want to enter an options straddle position as near as possible to the convergence of the two trend lines. Even at the point where the breakout begins will still work. The best straddle breakouts come after you see this pattern forming for about 3 months. Anything shorter than that may result in a breakout that doesn't have sufficient momentum to give you a decent profit. Another vital thing when choosing options straddles is that you need to ensure that the options you buy have at least 90 days to expiration. If you do this during a period of price consolidation, such as in the triangle pattern that you see here, the option prices are likely to be the cheapest around that time due to low price volatility. This is ideal for straddle trades. The downside of options straddle positions is that they cost more to enter than other trading strategies such as spreads. Nevertheless, on markets where option contracts only cover 100 shares, they are still quite affordable. If cost is a barrier to you, you might like to consider an alternative strategy called victory spreads. A double victory spread done with both calls and puts achieves exactly the same result as the option straddle, but only risking a minimal amount by comparison. You also want to avoid stocks that are historically slow moving, because the whole idea behind a straddle is to anticipate a short-term price breakout that moves far enough before expiration date to give you a net profit. Another indicator that a price breakout could be imminent is an upcoming earnings report, say in about 2 to 3 weeks. When an earnings report is pending, pay attention to the implied volatility, as option prices tend to become more expensive just before an earnings report is released. Alternatively, a large movement in the overall market due to current economic conditions can also affect individual stocks, but under general volatile market conditions, you might be better focusing your straddle play on index-related ETFs such as the SPY. Coming back to triangle patterns, there are 3 main types. Where the highs and lows are converging, this is called a symmetrical triangle. However, you often see the lows getting higher, but the highs being equal because they are hitting a resistance level. This is called an ascending triangle. The reverse of this is the third type, namely descending triangles. These are ideal conditions to implement a straddle strategy. The final thing you want to check before placing your options straddle position is the implied volatility in the option prices compared to the historical volatility of the underlying stock price. Ideally, the former should be lower than the latter. Any decent options broker will be able to provide this information. Finding triangle patterns, the easy and the hard way. Wading through a long list of stock charts to try and find triangle patterns can be a very tedious process. But if you have software or a broker service that allows stock scanning, you can make the process much quicker. Here's what you can do. There is an indicator known as the ADX, or Average Directional Index. It is usually used in conjunction with the plus DMI and the minus DMI indicators, but for our purpose we can ignore these. The general rule is that when the ADX crosses above 15, the market is likely to break out. Below 15, the market price action is consolidating. So if you or your broker have a scanning facility, you would set your stock price filter to between $20 and say $10,000 and your ADX filter to crossing above 15. It will produce a list of stocks that qualify for both parameters. So here's a checklist for finding options straddle candidates. This is a summary of the conditions you should expect to identify before you consider placing a straddle trade. Number 1. Earnings reports. Options implied volatilities should be lower in between company earnings reports, as there are no major announcements or conferences expected which might energise the price action. If you're scanning the market for straddle trade opportunities, you should begin your search by looking at stocks with upcoming earnings reports during the next fortnight. Number 2. Looking at a bar or candlestick chart of the underlying, you should be able to observe price consolidation. Comparing the size of the current daily bars with those in the past, it should be apparent that these bars are smaller than the historical ones. You want something that has had big moves in the past, which indicates that this stock's price does move, but now the price action is relatively quiet due to smaller intraday price moves. In consolidation mode, stocks also tend to have lower trading volumes. Under these conditions, the options will normally be cheaper. You will often find this phenomenon close to the end point of a triangle chart pattern, as described already. Number 3. The options must be cheap. By cheap, we mean that the implied volatility in the at-the-money option prices must be less than the historical volatility of the underlying security. Any good options broker should be able to deliver this information. For example, with Options Express, you can look at a price chart in Volatility View mode and easily compare the implied volatility with historical volatility. If all the above conditions are in place, you have an ideal setup for an options straddle trade. The options straddle is one of the safest and most stable option trading strategies available, because you've eliminated the need to predict market direction. It does have some risk, namely that the stock goes nowhere, in which case time decay, otherwise known as theta, on your bought positions will work against you. But if you followed the rules and purchased when implied volatility is low, the price is cheap, and there's plenty of time till expiration, your risk will be minimised. Straddle profits are theoretically unlimited, but anywhere between 20 to 50% per trade is quite easily attainable. A straddle alternative. There is an alternative that works exactly like the straddle, but with this difference. They are much cheaper to take positions on, and therefore the amount you lose if the stock goes nowhere is much less. They're also more flexible, cheaper to put on, and carry less risk. These nice little setups are called victory spreads.